Every few years, capital gains tax becomes the political punching bag. Slash the CGT discount, tax investors more, fix housing affordability. But here is the uncomfortable truth. If government gets this wrong, they won't make the housing more affordable. They will actually make it worse. And today I am going to show you how exactly that happens. Hi, I'm Ankit from ValueNest Buyers Agency and I specialize in research-led property investment strategies. I help property investors make confident, data-driven decisions by focusing on numbers and fundamentals, not just the headlines. So what is CGT? Let's start with the basics first of all, because a lot of people get this wrong. Capital gains tax is the tax you pay on profit when you sell an investment asset. Simple enough. But here is the part that actually matters. In Australia, if you hold a property for more than 12 months, you get a 50% CGT discount. So let's say if you buy an asset worth 600k and you sell it at 900k, your gain is 300k. With the discount, you are only taxed on $150,000. Without it, you are taxed on the full 300k. That discount is exactly what is on the chopping block. And this debate sounds reasonable on the surface until you look at what actually happens when you change it. So let's get into the numbers and what is actually being proposed. Now, first of all, nothing is law yet, but the proposals floating around include a lot of things. First one is reducing the discount from 50% down to 25% or 33%, limiting the discounts to new builds only, modifying or removing negative gearing, applying changes only to future purchases. Most proposals include something called grandfathering, meaning if you already own an asset, you are protected. The intention is very clear here: cool the investor demand, improve affordability, and raise revenue. But intentions and outcomes are two completely different things. Here's what the modeling often misses. Now, let's say the government announces tomorrow the changes in the CGT discounts, and the CGT discounts drops to 25% for any property purchased after the 1st of July 2026. What do you think happens next? Firstly, investors flood the market. Every investor who is sitting on the fence, waiting, watching, unsure, suddenly has a hard deadline to act before the rule changes. That creates a surge in demand, more competition at auctions, higher clearance rates, and short-term price acceleration. We have seen this play out before with first home buyer grants, stamp duty concessions, lending changes. Deadlines pull the demand forward. And here is the irony. The announcement of a tax tightening could cause a short-term property boom. Not a slowdown, a boom. Okay, so the deadline passes, July 2026 comes and goes. Now what next? Investor activity cools down, transaction volumes slow, sentiment softens. But here's what doesn't change. Supply is still tight, migration is still strong. We are still not building enough homes, which is basically the fundamental and underlying issue of Australian property market. Prices don't collapse in that environment, they stabilize. And then something else starts to happen. Something nobody is talking about. When CGT becomes less attractive, investors don't just stop buying, they stop selling as well, which is a key thing here. Think about it. If selling triggers a larger tax bill, the rational move is to hold the asset longer, avoid the tax event. Don't just sell it. What does that mean for the market? Fewer properties coming to market, less supply, more scarcity. Now, in a market that's already undersupplied, CGT tightening could actually reduce the number of listings available to the buyers. The policy designed to help buyers removes stock from the market they are trying to buy in. Now, that's not a conspiracy theory, that's the basic human behavior around tax incentives. Now, let's look at some of the numbers over the time, especially for the long-term investors. Does this even change the outcome? Let's say you buy a property at 700k, hold it for 15 years. Now property grows to $1.4 million. Your gain is approximately 700k. Even with a reduced CGT discount, the majority of the wealth came from compounding growth over time, not from the tax discount. Serious long-term investors are rarely derailed by moderate tax changes. They adjust their strategy and keep going. Let's look at the real problem now. And here is, what frustrates me about this entire debate. Housing affordability is not primarily a tax problem. It is a supply problem. Planning restrictions, construction costs, infrastructure bottlenecks, population growth, which is outpacing new homes. That is the real problem which Australian property market is facing. Tax policy influences demand at the margin, but supply constraints drive prices over the long term. If we don't fix the supply problem, and we haven't, then shuffling CGT rules just reshuffles who is buying and when. It does not fix the underlying imbalance. So here is the key takeaway. If CGT changes are announced with a future start date, expect more buying before that deadline, not less. And if investors respond by holding longer, expect fewer listings, not more. Now the bigger question was never about tax. It's whether we are actually building enough homes. So if you found this video useful, subscribe, because this is exactly the kind of things I cover every week. And if you are thinking about buying in this market, want someone in your corner, reach out. The link is below. Thank you. See you in the next video.